Welcome, ladies and gentlemen, and a good morning to you all. We're here for the Artemis Alpha Trust investor presentation. This presentation is being hosted on Research Tree by Doceo and Capital Access Group. As we proceed with this recorded session, investors will be in listen-only mode. We strongly encourage questions, which you can submit at any time through the Q&A tab on the right-hand corner of your screen. Simply enter your questions and press send. If you would like to leave feedback, please hold on at the end of the session and there will be a short survey you can fill in. While the company may not respond to every question during the meeting itself, be assured that management will review all questions and, where appropriate, publish responses. You'll find these responses on the event page on Research Tree. Without further ado, I'd like to pass the baton to Kartik, Fund Manager of Artemis Alpha Trust. A very good morning to you, Kartik.
Good morning. Right. Okay. Thank you. On the agenda for today is three things. I wanted to give you my overview of what I think you can expect from the macro, the essence of what Artemis Alpha is, and then lastly, I thought I'd actually talk about our stock, what is actually the largest stock in the portfolio. So coming on to macro, I'll start there. I can touch on performance in a second. I guess actually just taking one step back, Artemis Alpha is a long-term value-based UK multi-cap fund. And the first thing I wanted to do is talk about how the macro is really quite ugly in the UK and how I see that evolving. So the first point I wanted to answer, the question I wanted to answer was, will inflation ease? And I think there's quite an important point to note here, which is just that there are a number of exogenous factors that have led to a pretty unusual situation resulting in high inflation. And the shocks there really are the pandemic, the monetary response to the pandemic, and then more recently, war in Russia and Ukraine. If you look at it from a demand side, I think there are a couple of points to note. Is during the pandemic, effectively you couldn't consume services. Demand shifted rapidly to goods. We've seen that change recently, but evidently a lot of that demand was hard to meet at the time. There was abnormal money supply, as frankly no one really knew how the pandemic would unfold, and as a result of not really being able to spend the money that was in many cases dropped into your pocket, savings rates were elevated during the lockdown. On the other side, there are a number of supply factors. Supply chains, as we know, were heavily disrupted due to the physical impact of the pandemic. Energy supply has had various threats, and as you know, Russian gas supplies to Europe have been curtailed. And then lastly, slightly unusually, is we've seen an adverse impact to labour market participation coming out of the pandemic. So I want to just talk through why I think these factors are to a degree temporary, and why that means that I think it's logical to expect inflation to fall. So if you look back 2020, one of the few groups of effective commentators who called inflation correctly were monetarists. And monetarists were pointing out that at the end of 2020, you had really astonishingly high levels of money supply growth. And that's really across the board in the UK, Europe, and the US. And really quite an important point to note is that those money supply growth rates have turned sharply negative, particularly in the US, less so in the UK, but even more recently in Europe. And evidently, the monetarist school of thought is that, frankly, inflation is always a monetary phenomenon. And as a result, inflation will match changes in money supply. If you look at supply chains, you can see really how temporary the distortions were in certain elements. And here, this is Shanghai container freight rates. But you can see how the peak rates that we saw at points last year have really normalized. And it's a similar story in energy, although I would note that gas prices, particularly in the UK and wider across Europe, have really been helped by how warm the last two winters have been. So if you look at this, what you're starting to see is less so in the UK, but inflation rates really are cooling quite quickly. And in my view, it'd be logical that if you were looking at the factors that have driven an increase in inflation, it is pretty logical that many of those are actually resolving themselves. The one key risk to this view, which I would call out, is labour markets. So labour markets are tight, particularly in the UK. And that's one of the reasons why you also see this divergence between consumer confidence that's very low, but actually GDP that's actually quite resilient. And that has to do with the fact that we haven't really seen a significant uptake in unemployment. But we know that there are factors that can stop that. I mean, the recession is the easiest one that would increase labour supply, but you're also seeing an improvement in migration in the UK, many of which the sort of more pessimistic observers would have said would be a likely negative from Brexit. In terms of why invest in UK stocks, is sort of I just wanted to show you my framework here, because I think you can kind of see sort of empirically why UK stocks are cheap. Just to point out, I mean, the UK is being called a submerging economy. The UK market similarly is sort of cast in a negative light for that. But there are lots of great things about the UK. It is global services centre. It's extremely well located from a time perspective. Strong institutions. A lot of legal cases around the world are resolved in British courts. English language, monetary independence. So it's really quite important to remember that the UK has its own currency and can set its own interest rates. A pro-business climate, I guess I have to sort of question that in recent years, but theoretically, and I think relative to certain places of the world, that is the case. But most importantly, I want to show you how I think about this, is I think you can see very clearly that the risk premium, and that is the compensation that you receive for investing with the uncertainty in equities, is elevated in the UK. Now, this is something that I think is kind of forgotten, and why the rise in equity markets are baffling a lot of people, which is that all else being equal, inflation is a positive for equities. And why is that? That's because in the long run, you are owning a perpetuity that is dictated in nominal terms. And therefore, as all else being equal, nominal GDP rises and corporate earnings rise with higher inflation. Now, there's a counterbalancing fact to that, which is a higher discount rate reduces the value of equities, because effectively money today is worth more than it is tomorrow, than when you say have zero interest rates. But why I think this is very important is because people aren't really thinking about equity values in real terms. And I'll give you one example there. Is if you look at the FTSE 250, it's broadly 20% in price terms below its 2019 levels. Well, if you deduct CPI from that, you're close to 40% down in real terms from 2019 levels. And so that's why the bear market really is a bit more vicious than you think it is in real terms. And it's why equities, and if you take a sort of example like Coca-Cola, it's why inflation, all else being equal, will increase the value of equities. Now, if you look at the UK, so what this chart shows you is it's the earnings yield. So it's just the inverse of the PE ratio of the FTSE All-Share. And it charts it against the 10-year real bond yield and in the UK. So today that's about 0.8%. So if you want to earn effectively a risk-free return in the UK that's inflation-linked, you will today get paid 0.7% over 10 years above inflation. And just as a reminder, that's the best you can do. So if you buy that bond, you hold it for 10 years, and inflation is 4%, you're going to earn 4.7. And if inflation is 2, you're going to earn 2.7, but you're going to earn 0.7% in real terms. Well, that compares to an earnings yield on the FTSE All-Share, which is today approximately 10-11%. Now, in the long term, you would expect corporate earnings to grow by real GDP and inflation, and that's why it's appropriate to effectively compare what is a nominal number in your earnings yield to the real yield on UK bonds. And that's how you can see, if you look at this spread over time, you can see that statistically, the UK is about as cheap as it was coming out of the Eurozone crisis. And you can see that back in the 90s, when interest rates were effectively normal as they are today, equity risk premium was materially lower than it is now. If you were to draw these same charts for, say, the US market, you would find that equity risk premium is about 4%. If you were to do it in Europe, it's about 7%. Now, some of those factors are reflecting effectively the fact that a large proportion of the UK market is cyclical. I believe some investors would say banks, commodities, and oil evidently should have a higher risk premium than technology companies. And so I have sympathy with those views. But what I would just point out is there is a very clear case for saying that empirically today, UK equities are attractive, and that isn't the case in many areas of the world. I'm now going to go through a couple of points on effectively what I would call is the essence, and I've sort of boiled it down so I can talk to you about a stock of Artemis Alpha. So firstly, Artemis Alpha, in my opinion, is a very key point, is where almost an owner-run trust. So close to 30% of the trust is owned by current and ex-employees. My colleague John Dodd, who I run the trust with, is the second largest shareholder. You can see from disclosures that I invest a lot of money in the trust. So we always say that we really try and run it as if the money were our own, and we feel gains and losses just as any other investor would. The portfolio is driven by a very bottom-up stock picking process that's driven on fundamental research. And you'll see in subsequent slides that we're quite highly concentrated in areas where we have high conviction. So currently about the top 10 names in the portfolio are about 60% of the assets, and our tracking error, that is to say how much we are likely to deviate from the index by, can be in the region of 15 to 22%. So really the portfolio will look and behave very differently to the FTSE All-Share. And I think it's quite important that you recognize that if you're looking at investing in the trust. Otherwise, I suspect you might be quite surprised by the results. If you look at the portfolio today, and I'll show you this in a different way, we're really focused on kind of two areas of the market. One is capital cycles, so industries where capacity and demand are mismatched, and that's leading to a rise in returns, and durable franchises. So these are the sort of more bond proxy-like businesses where you can be really quite confident in their long-term future, but in our judgment, they're attractively valued today. An unusual feature about our trust relative to its market cap is actually we have a very liquid underlying portfolio. So roughly 70% of our portfolio is in stocks that are really quite liquid. And we like that because it means there's a low opportunity cost in being able to change your mind. And the last point to note is that as we sit today, we very much are seeing a value opportunity in the UK. Over 55% of our net assets by value are in the UK market. Sorry, are in domestic UK stocks. Just touching on, I think a couple of things that encapsulate our process. I'm going to do two slides here. Is effectively we see excess returns as coming from excess stock market returns as coming from three areas. Number one, and I think it's a Soros quote, which is that to be a differentiated investor, to be a better investor, you have to have a differentiated view on risk or return. And I think it's quite important to note that it's on both factors. It's not just assessing what are the greatest winners, but it's also recognizing when the risks in the stock change. It's easy to say this one, it's harder to do, but effectively to deliver long-term alpha, to some extent, you need to be robotic about minimizing your behavioral biases. We have various processes that we try and do that. And the last point is money management. So this is to say that you really want to construct a portfolio that helps you take advantage of opportunities in the market. And you want to be very, it's a Markovitz passed away recently. But his point is that you can have two, having stocks with inverse correlations can effectively advance your overall returns in a way that wouldn't be the case if they were correlated. I'm going to illustrate this with a stock example in a second, but one of the things that I think are slightly differentiated by our fund is we have an internal IRR framework. So we try and effectively look to forecast the earnings as well as the capital allocation, how that money is allocated by the business, whether we get it back in dividends or whether it's being reinvested for future growth, and be quite prescriptive about how we believe the market or how we would value those earnings, to come up with a view of, well, if you pay X for a stock today, over 5 years, 3 years, how much are you expecting to make from it? And why that's important is because, in our judgment, time is money. So it's not enough to just say that there's a lot of upside in the stock. You want to be really quite prescriptive because then you can break down and decompose your mistakes as and when they happen. The portfolio today, if I were to give you a very brief overview, if you were to look at it, we effectively have 40% of our capital in capital cycle businesses. So this is UK retailers, where evidently there's been a lot of capacity rationalization. Airlines, where similarly the pandemic blew a hole in the industry's profitability for nearly 3 years. And there's now a shortage of planes out to 2030. House builders, where there's sort of effectively perennial cash machines in the UK that the market panics about every couple of years, but the structural undersupply in the UK doesn't change. And commodities, which is a more recent purchase, partly because we think they're a good hedge to some of our consumer exposures, but also because in their own right, they've been suffering from an underinvestment in the past. And then we similarly have what I would call idiosyncratic exposures. So UK banks represent, in our opinion, the market hasn't recognised the step change in profitability for interest rates, so they act as an interest rate hedge in the portfolio. We have a large holding in Dignity, which is a operator of crematorium funerals in the UK. I think that's a very attractive market. And then we have other holdings such as Just Eat and Delivery here in the technology space. They've been quite damaging to the fund in the last 18 months, but we've held them for a long time. And then you move down into what I would call the sort of compounding franchises. So this is more businesses like a GSK, Haleon, which was the spin-off from it, Consumer Staples, Hargreaves Lansdown, which was a more recent purchase, as was LSC, or Plus 500, which we've held since its IPO. But these are businesses where the returns tend to be more predictable and less cyclical. And that's effectively how the portfolio is composed today. I thought I'd give you about 6-7 minutes on what is the largest stock in the portfolio. And maybe I'll start with this slide just to point out. So we've held Frasers Group since 2016. We invested about 5% of the capital in it, and it's compounded at over a rate of 20% a year. And today it's about 12 to 13% of NAV. So it's the largest holding by some way. And I wanted to sort of bring it to light by explaining why we hold it, and also how I look at the potential returns in it, to give you an insight into how we think. So the first thing I just point out here is it is an easy holding. I mean, many things which compound at 20% a year, it can be hard to hold them. But in our time from 2016 to today, I think we've seen a 350% drawdowns in the stock. We haven't really bought or sold shares since 2018. And all along the way, we've learned more and always consistently revised our views about the forward expectations of the business. But here, I'll give you a bit of sort of a pitch effectively on Frasers. So why do we like Frasers, and why is it still the largest holding in the portfolio? So firstly, if you look at the sportswear business, sportswear in the UK is effectively a duopoly between JD Sports and Frasers, but they occupy very different segments of it. And one point that I think isn't really noted is really how competitive on pricing is. So anyone with kids who bought football boots would know that there are really few other places to go. But generally, in the sporting goods segment, this is tennis rackets, practical kit that you need to play sports. Sportswear really is a dominant leader. And what's a very nice thing about that market is it's firstly stable. And secondly, it's growing because of demographic change. So A, being more healthy, and B, also, a 50-year-old in 20 years' time is more likely to wear tracksuits, or actually, sorry, a 50-year-old today is more likely to wear tracksuits than a 50-year-old 20 years ago. But so the sportswear business, which has really funded the cash of the business for over 20 years, is I think, a very attractive part of it. Luxury retail is a segment which I think some people don't even know Frasers have, but it's in the flannels part, which was an acquisition which they made, and they've grown to nearly £1 billion worth of sales today. But this is a very interesting business because effectively it's growing in the segment which department stores left. And so here, if you look on the left, this is Liverpool, where they've just opened a 120,000 square foot store. If you look at luxury goods performance more broadly, there's a reason why LVMH is the largest stock in Europe. Bernard is the richest man in Europe, and it's because luxury has got a tailwind from effectively demographic change, where social media has really increased the addressable market for luxury. But flannels is a business that's grown revenue over 35%. And what's really, again, interesting, it's got a similar characteristic to the sports business, which is that it has very, very few competitors in the UK. So it does have some online-only competitors, Net-a-Porter, Matches, which is struggling, My Theresa from Holland. And then it's got some physical retailers, but who are largely focused on London. Selfridges, Harrods. Selfridges does have a couple of regional and very profitable stores. A key part about Frasers, which I think, say, distinguishes it from, say, a Next Group, which is also an excellent retailer, is it's got a core proposition around its own brands. So this is Slazenger, Dunlop, Caramore, Everlast. Everlast, as an example, has an 80% share in mixed martial arts. I mean, it's just a huge global brand, which allows the company to set its prices and will always remain a good reason for customers to come to the store. In our judgment, Frasers has the lowest cost operation. So if we benchmark it on a operating cost per square foot basis to peers, we find it's the lowest. Capital allocation is something I'll talk about in a subsequent slide. But also one part that I find, and alongside that is effectively, if you're investing in Frasers, you're investing alongside Mike Ashley. A lot of people would say, why would you do that? I think I'll show you. But effectively, if you look at it, the senior management team of Frasers take no salary from the business. Mike Ashley owns 70% of the company. And so what you are really doing is investing with someone who's very aligned with your interests. And I'll show you why we think Frasers may return over 30% a year. So one point that I think is underappreciated with this company is how much it's changed. If you look on the left, this is a couple of years ago, it's the old Birmingham stores. You had umbrellas by the door. It was very disorderly. It was the pilot high, sell it cheap. If you look on the right, that's what Sports Direct looks like now. And actually, interestingly, Nike reported last week, and for the first time ever, Sports Direct were announced as a global partner, one of the few, alongside JD Sports and Dick's Sporting Goods. Why does this matter? So we track the ranges in the store, and if you look at it today, you can walk into a Sports Direct and buy a £200 pair of running shoes or running shoes or football boots. That increases your gross profit per square foot, and effectively you're riding on the R&D spend, and marketing spend of Nike and Adidas in a way that you aren't if you're running purely the pile 'em high, sell 'em cheap model. As I noted earlier, I mean, we've tracked this for a really long time, but Sports Direct really are very sharp on price. This is both on, some of these are own label, but also if you look at generic goods, it's a core retail skill where they're great. Similarly, I could show you one for flannels, but if you look, they're rarely beaten on price, and their SKUs, so the range that they hold is constantly improving as the business scales, both physically and from an online perspective. This is a point which I think some haven't noticed. I've been to Schaerbeek 3 times since we've held this, and the company's invested over £200 million in automating it. Schaerbeek is in the Midlands. It's about 42 football pitches big. It's just enormous. And the company has actually the largest auto store installation in Europe. So it's actually one thing which Mike Ashley himself it takes responsibility for, which is automating the logistics. Why is this important? Because effectively a lot of retail, if you think about it on the front end, it's merchandising and pricing. On the back end, it's being as efficient as you can. And if you have a really efficient back end, what you can do is you can handle stock in a way that others can't. And you can do things like you can buy Jack Wills that's losing money 1 minute and effectively strip out all the cost and have a brand which is literally profitable the next day. And it explains why I think some aren't fully aware from the outside why they're so acquisitive. It's because effectively the company can bolt in brands onto its platform, both stores and back end, in a way that makes it really very compelling, especially when you pay the prices that the business has. Gies and Hawkes, another recent example. This is a point on capital allocation where I think, as you might have noticed from my IRR slide, it's really important because businesses that can allocate capital well at high rates of return, just from a theoretical standpoint, should be worth much more than a business that can't. And what I think is really, at this point in Frasers, I don't think it's given enough credit for it. But if you look from 2015 to the last set of annual results, which will nearly be a year ago, they'll report in July, operating cash flows increased by 100%. But if you look within that, you'll see that nearly 40% of that's been given back to you on a free cash flow level. 40% of it's been invested in property. So the company today has over £1 billion of freehold property on its balance sheet. And this is for a company that's worth £3 billion. And then a third of it's been invested in PP&E. But effectively, this is a business that's able to grow its cash flow at very high rates, but also reinvesting it in ways that add value. And if you look, even as of today, the company's bought back over £120 million of its own stock. And the share count since we've been invested has fallen by 25%. That has a really huge impact if you think about what happens to free cash flow per share if you're reducing your share count by 3-4% a year. But I think businesses like this in America tend to trade on very, very high valuations because you're reinvesting your cash flow at these high rates. But I think this is an element of Frasers which isn't fully recognized. And lastly, this is just to point out, I think it illustrates why the UK is cheap. I think it illustrates why we're very confident in the prospects for our largest holding. But if you're looking at phrases, and so if these earnings numbers are broadly in line with consensus, there have been times where we've had a very different view. But if we just take consensus as an example, over the next 3 years, operating profit expectations are about 9% a year, and that's as Flannels kind of scales and increases its margins and grows, but the sports business continues to do what it does. You get about 3% back a year through share purchases. Bear in mind that that's about £90 million a year, and the free float of this company is only £1 billion. And the stock today is at £7, and on a prospective basis, it'll be making £1. So you're paying 7 times earnings. And mathematically, if you add those numbers together and say, well, what's the right price for a retailer that is the lowest cost operator, that has a cash cow sports business, and over 30% of its earnings being luxury, well, 12 times earnings is what Next trades at. It's actually a bit higher than that. And so I'm factoring in some sort of conglomerate discount. You'd be making over 30% a year over the next 3 years. And bear in mind, that would get you to 13 quid a share, which is below the management incentive package of 15 quid. None of this has upside for some very credible factors that I think are possible. So the various M&A initiatives that are always ongoing, and where I think the return potential is always asymmetric. Financing is probably the biggest one. So if you look, Next makes about £160 million from interest income each year. This is financing purchases. Frasers theoretically could make quite a lot more than that because of its own label structure. So you make money from the incremental sales, but also from financing it. And, the forward forecasts don't include anything for that, even though the company spent quite a lot of money buying studio retail and has built up its Frasers Pay solution. And then lastly, Europe. So relationships with Nike and Adidas are very strong. And in Europe, there's effectively no consolidated sporting goods retailer. So I think I'll stop there for questions, but I hope that gives you an indication of what we think about the macro, and also a bit of an essence of the fund, and also one of our stocks.
That's great, Kartik. Thank you so much for taking the time to give this presentation today. Now, we've got quite a few questions in already, but to everyone present, I would encourage you to continue sending over your questions using the Q&A tab in the right-hand corner of your screen. As we go over the questions we've received so far, I want to point out that the recording of this presentation, together with the slides and the published Q&A, will be accessible on the event page shortly after this call. Now, Kartik, we've got about 15-20 minutes for the questions. I'd like to thank everyone for participating in the call and for their active involvement in submitting them. One thing that I would really like to understand is, as a multi-cap portfolio, you presumably have quite a lot of freedom in running it. Do you sort of enjoy and make the most of that freedom? And which areas are you seeing the best opportunities in at the moment?
Yes. I mean, the portfolio in general has a pretty unconstrained approach, and so we hold Google, that's worth 1.2 trillion, and we hold Springfield Properties in Scotland, which is currently trading on half times book. So I would say actually where I see the most compelling opportunities today are in large cap deep cyclicals. Now, you could say that the value is there for a reason, but if you look statistically, GMO have done some work on this, and effectively large cap value is trading like the world's crumbling, whether it's NatWest on 4.5 times earnings, or EasyJet, which in my opinion is probably on 6-7 times earnings. It's I think there's a lot of value in large cap, but it would be logical that if large cap's cheap, then small cap will be even cheaper. But I guess I put a bit of a weighting on the opportunity cost.
Great, thank you. So now somebody's asked what goes into determining position sizing, and I think also allied to that, how long would you typically hold a stock for?
How long do we typically hold a stock for? Holding period can be really quite long. So and the turnover of names is lower than the turnover capital. I don't actually know what our turnover number is, and bear in mind I took on the portfolio in 2018, so it'll be distorted. by the turnover I did there. But if you look, plus, I think I've looked at this before, and 7% of our top 10 have been held for over 5 years. So generally, sort of like to do a lot of work on the house that we plan to live in, and then stay there. But broadly speaking, quite a long-term time horizon, but it'd be slightly distorted by the changes I made to the fund when I took it over. In terms of position sizing, it's a number of different factors. But the key one being that we effectively try and come up with an ex-ante view of what the risk-adjusted return is on a holding, and what the skew is, and then how confident you are in it. And let's say it was idiosyncratic. Those are all stock level features. Let's say it was idiosyncratic and uncorrelated. Then we usually, we could have a max position size of probably 6.5% is what we've tended to do. What we overlay onto it is the portfolio level factors. So the opportunity cost, the correlation, the sector weightings, and we tend not to have much more than 10% at cost in sectors, but we sometimes have we've let it run up to 12, 13. But so it's a number of factors that effectively lay on your judgment of the risk-adjusted returns on a stock level, and then how additive that stock is on a portfolio level that determine the position sizing. As you can probably see from the weightings today, I mean, one mantra that I do try and abide by is run your winners, but especially when effectively you're still ticking the boxes from a position sizing checklist, which we run.
Thank you. Now, we've got a few questions on Frasers Group, one of which relates to your last point. So the attendees asked, I see you haven't traded around your Frasers position since you opened it in 2016. Was that a difficult decision during those big price drops and recoveries?
Yes, because if you think about it, if you've got a large holding and it was £9 in December and it's £7 today, you can underperform the stock market very easily. But the reason you hold it is if you put that 30% return in pound terms, it's because I have a sort of reasonable level of confidence that the stock's worth 13 to 15 pounds. So absolutely, and we've tolerated a lot of volatility in a number of holdings, but you're effectively always trying to reassess your view of the risk and the reward in the holding. And I'll give you a small example. When we were buying Frasers at £3 a share in 2016 and all the way down to, I think the lowest price we paid is £1.90. I think our judgment of the value was £4 to £6. So it's changed a lot over time, and you do get a lot of volatility. And when you have a large position with high volatility like Frasers, it can be quite hard to hold on. But that's why, as I said, we try and run the trust like it's our money and your money, and we try and avoid some of the sort of shorter term factors that create noise, and probably what's quite well publicized is excessive trading by institutional investors.
Thank you. Now another question on Frasers Group. It was quite striking, the slide you showed on their pricing on various items versus Amazon. So our attendee has asked, how are Frasers Group able to be so much more competitive than Amazon on pricing and still generate returns for shareholders?
So an interesting one is if you compare Frasers to Currys, right, which we have a holding in and it's been wrong and it's been painful. Effectively, sporting goods are protected by brands and the distribution surrounding brands. So Frasers is advantaged because it owns some of those brands. And then secondly, it's protected by the distribution on the latter. And thirdly, Mike Ashley is absolutely, he knows customers vote with their feet. Customers are very smart. The consumer is very smart. You end up like Debenhams if you don't respect the fact that if Amazon's more convenient, there's no way that you can charge more than them. And yes, that is the crux of why I think that's why I think it's such an incredible retailer, because it's been steadily grown its profits for a very long period of time whilst being competitive with Amazon. And therefore you don't need to put it on 4 times earnings because you're worried it's got no duration or terminal multiple. But you can do it, check it yourself if you have any doubts. And, I do it with a bunch of different retailers. I do one with Currys and it's there or thereabouts, but it's nothing like this.
Thank you. Right, so we've got a couple on the sort of the more macro-ish picture here. So somebody's asked about the equity risk premium, which you point out is high in the UK at the moment, and he said equity risk premium can frequently be deceptively high. Either earnings estimates are too high, or the market is only beginning a structural derating, Brexit, anti-immigration policies, record debt headwinds, etc. What's your view on these two factors?
I don't think you're wrong, and that's that's why the risks. That's why the return in equities is uncertain, and your assessment of return is only one factor. So, if those are credible factors, put it this way: if you could get the same return in Nestle as you could in the UK market, well, I think everyone would agree that Nestle is a lower risk proposition, and therefore it's more attractive. You could do it, and we talk about this. You could do something like risk the earnings in banks, commodities, and oils. But that's 30% of the index. It's probably a higher weighting of profits. You'd still find a very high equity risk premium. So I'm just trying to illustrate it to you. If you look historically as well, particularly from the way it's shown here, you can see that when equity risk premium has gapped out like this, it has historically been a good time to buy, but I totally I recognize your points, and I think they're valid, valid observations. Thank you.
So a question on performance. One of our attendees has said, over the past 5 years, Artemis Alpha is showing a negative return, and the yield is quite low. Is the UK stock market no longer important to investors if professional investors cannot generate positive returns? Now, in your defence, I would note that your 3-year performance numbers look a lot better. But yes, if you'd like to take that in its context.
Yeah. So look, firstly, I'm sorry for hiding from the performance slide initially. I didn't intend to do that, and the performance has been patchy, to say the least. I took over the fund in 2018. I wrote off a substantial chunk of our private investments. I had a very strong 2019, 2020, and then a weak 21, 22. What gives me confidence is my judgment of the prospective returns. Bear in mind that I feel I kind of make the sort of remark sometimes that it would be impossible for someone to have more of their net worth in the fund than I do. I think that's likely true. So it disappoints me that returns in the UK market have been this pedestrian. Pedestrian is actually probably a generous term, and that we haven't been able to do better. But the only thing I'd say is, empirically, I don't think these numbers are lying. And if I show you this. If you run this equation on NatWest as an example, the implied cost of equity in NatWest is probably high teens %. So ultimately, financial markets are a capitalist system that's reflexive. If everyone works out that Legal & General doesn't get re-rated for paying a steady dividend for 10 years, I suspect everyone will switch to buybacks. And buybacks have a benefit of compounding your earnings per share and price. So something will give eventually, unless the cash flow gives, and then in which case my judgments are wrong. And that's possible. That's always possible. But I think if you look at it on that basis, and if I'd said this 2 years ago, I would have been wrong, even though I would argue that the rationale would have been correct, is effectively the UK market's been moribund since 2016. You then had the pandemic, and then now you've had a series of political issues that have compounded all those factors. But I think you're getting paid for it in the price of equities. The only thing I'd say is, don't get me wrong, we have 25% of the portfolio invested overseas, so I don't think we're in the sort of camp of we just cannot believe how cheap the UK is, and I'd make some 20-year prediction about it. I think the world changes a lot, and right now value looks very compelling. Might be wrong, but to me, on an empirical basis across a variety of the sectors we look at, the value looks really quite incredible. I'll give you one last example. Hargreaves Lansdown trades on 12 times earnings. Used to trade on 30 times earnings. If you look at the business model and you showed me the share price, I would have thought Apple must have a killer product in the market. It's just derated from 30 times earnings to 12. It's worth It's worth £4 billion with £500 million of cash on the balance sheet. JP Morgan paid £1 billion for Nutmeg. So some of this stuff, now I could be wrong. Maybe Apple will be the largest asset gatherer in the UK in 10 years' time and have come up with something with better customer service than Hargreaves. But Hargreaves does have 140 billion of AUM starting and some reasons for why customers can't be bothered to switch. So for all those factors, I recognise, firstly, UK's poor performance. Secondly, I would have liked to have substantially outperformed the market, haven't done that. But the optimism I have comes from looking at what we hold and the values that we have it. Our judgment, the prospective returns. The last point I'd make is you can imagine if you do an IRR on stock at every stock in the portfolio, you can weight it up and you can think about what, in my opinion, the prospective IRR on the whole portfolio is, and it's in my opinion, very attractive.
Thank you. You mentioned some of your overseas tech holdings there. Now, obviously, US tech had a pretty bad year last year, but has recovered very well year to date. What's your view on the outlook? Is it a renewed bull market, or is it more of a dead cat bounce in tech?
I don't like to make generalizations because, let's take Google as an example. We bought Google in October to January, and on the same IRR basis, the stock was trading on a 30% discount to Auto Trader. It's trading on 16 times earnings, growing roughly at 10% a year, and it doesn't need much of its cash. So we are forecasting returns above 20 for it. They've come down because the stock's up 35%. Meta, as an example, we bought in October $95. It's now $283. The returns have gone from in excess of 30 to 12. Now, so usually when stock prices go up, the prospective returns go down. There can be factors that mean that there's new upside risks, and I'm sure there's some. But broadly speaking, my view would be they got too cheap for what are very resilient business models. Some of the most attractive business models that have been invented because of how capital light they are. And now the prospective returns are less compelling, and we'll shift accordingly if that changes. Obviously, some of it, take Meta as an example. I mean, the stock's on probably 18 times earnings. It's not extraordinary what you're being asked for, and it's hard to price in some of the upside that could come from some of the generative AI technology. If you ask me to say, do I think Nvidia is cheap on 30 times sales, I'd find it very, very hard to say that, but I wouldn't have held it for a, three bagger in 2 years as it's been either. So I think it's hard to make a generalization. I think what we hold represents good value. I think there's a diversification benefit, and we'll change our mind if that equation changes.
Thank you. Related to that point, one of our attendees has asked, what's required before you exit a position?
A couple of things is either we have got it wrong, so we've misjudged the risk or return potential, and therefore we view it, effectively we say our judgment's wrong, we need to move on. And as an example, I did that with IWG, which is the workspace serviced office group. Or it can be that effectively we think the prospective returns are better elsewhere. So Flutter is a business that we've held in the fund various times in the last few years, but I sold in Q1 because the return forecast that I was making had reduced, and gambling companies carry certain regulatory risks that are hard to forecast. So that's usually why we will exit or change around. But it's another, yes, it's largely those factors. It can be a stock call or a portfolio call.
Thank you. So we're almost out of time, but one last question. From what you've told us about the portfolio today, you're using the investment trust structure to your benefit. You're able to hold quite large positions. You're able to hold, positions in unquoted stocks, even if that's not something that you particularly pursue. Do you use gearing?
Yes, the portfolio is about 12% geared today.
And how do you achieve that? And do you spread it across the portfolio, or do you invest it in in individual opportunities?
It doesn't. It by definition it's spread across the portfolio, because the way we do it, because we've got quite a liquid portfolio, is through contracts for difference. In my opinion, that's a better way if you've got the liquidity to do it, because you don't have unutilized fees, lending fees. You have no covenants. Not that we'd want to get close to those. So in my opinion, it's the lowest cost and most efficient way to be geared in an investment trust structure. And if you look at it, how we've used it, I removed the gearing in 2018 when I was trying to implement changes to the portfolio. In COVID, in April 2020, we went to about 10% geared. And then we've been broadly at that level since then. Max you'll see us have is about 13, 14, but even then it's on a temporary basis. So I broadly say that we don't really like to be above 12.5%, because frankly, equity markets can be far more volatile than you could imagine. And we have a hard cap at 25, so I don't ever really want to be near there. But the level of gearing depends on a number of factors. We look at the financial gearing, the portfolio, the operational gearing, its cyclicality. So, if we ran a portfolio full of consumer staples, which is extremely unlikely, I'd be much more comfortable with gearing than if we have a portfolio full of banks. So that's how we look at it, and we're quite optimistic. We're quite opportunistic about how we use it.
Thank you. Well, perhaps quite optimistic as well. Then, if you're close to the top of the level that you'd see as the maximum. So, Kartik, thank you so much for answering all the questions that we've posed. Should there be additional inquiries, they'll be made accessible to you right after the presentation for your review. It would be greatly appreciated if you could provide your responses where suitable, and these will be published on our event page. So, just to conclude, many thanks again for your presentation this morning, Kartik. To all our investor attendees, we kindly request you to keep this session open, as we'll be automatically redirecting you to a feedback form. The insights from this form will greatly assist the management team in understanding your perspectives and expectations more clearly. We sincerely appreciate your participation in today's presentation, and will now bring the session to a close. Good day to you all.